Well, SBI Cards is on our radar on the back of their Q4 earnings. Now, the company has lost market share in Q4, but the net interest margin has improved and return ratios have been robust this time around. Rama Mohan Rao Amara, the Managing Director and Chief Executive Officer at SBI Cards, joins us now to talk about that. Mr. Rao, always a pleasure speaking with you, not just to learn about your earnings, but about the industry as a whole. You've lost a bit of market share for the second quarter in a row. Why is that, and what are you doing to address the situation?
Yeah. Good morning, Sonia, and thanks for inviting me to the show. If I talk about the SIF kind of market share, which has slightly declined by 10 to 15 basis points, I think our acquisition strategy has always been like a factoring the market dynamics and our own strengths, like what is the distribution strength we have and the kind of partnerships and access to database, etc. And internal risk appetite in terms of certain customer segments. And this has actually worked well. If you look at our run rate quarter on quarter, I think the card acquisition improved quarter on quarter. In the last 2 quarters, we have recorded around 1 million new accounts. So we'll continue to evaluate the kind of opportunities. We are taking a kind of renewed interest in the NTCC kind of segment. We are underwriting that segment with the help of alternate data. So we are continuously looking at the opportunities that are available. Spends wise, again, it's a good story. I think both the industry and SBI Card has crossed to pre-COVID levels in second quarter itself. And both retail and corporate have done well for us. In fact, the corporate spends have increased by 100%. Retail has increased by around 43% year on year. More notable point is the per card kind of spend when we look at, I think it increased from 1,23,000 to 1,61,000 rupees, which shows our kind of engagement with the customer and the kind of initiatives what we are taking and the overall activity rate in the portfolio. So we always aim at a kind of sustainable growth rate. We always come out with the kind of products that will work for the customer and the kind of partnerships we enter into for overall enhancing the customer experience. So we'll keep an eye on the market share, but at the same time, we will also be mindful of the sustainability.
All right, Mr. Amara, good morning, Prashant here. What kind of growth are you expecting in revolving credit? If you can give us a sense in FY23, that has been a bit of a worry point for investors.
Yes, revolver, it was around 27% as of December. It came down to 25%. But internally, our analysis indicates the revolver rate, the rate at which the spends get converted into revolver, that remained stable. And a couple of months, we have even seen a kind of uptick up to February 2022. But month of March, actually, a kind of elevated spends were there, particularly in the second half of March, around 3,500 crores retail spends, which did not get the opportunity to get converted into revolver. But having said that, looking at the kind of declining credit cost, we are exercising the increased risk appetite. We are permitting more of a self-employed, more of a NTCC kind of segment of customers who have better propensity to revolve. So I think these steps are the right steps, but it's an industry phenomenon. We are taking all the steps that are needed, and we hope it will improve in the times to come.
But on an average, Mr. Amara, do you think that this whole credit card business for the industry could get impacted in the years to come, purely because, we're seeing quite a bit of disruption from fintech players? The usage of credit cards has perhaps gone down as well through the pandemic. Your sense?
I think credit card with its features of a combination of being a payment enabler and then with flexibility of availing credit at the time of point of sale or after swiping the card, and with a rich value proposition continues to be attractive. Even when we studied the other alternate forms of payment, whether it's a BNPL or whether it is a UPI, particularly P2M, there is a differentiation between the credit card average ticket size versus the kind of ticket size that is there in the other segments. And which is a credit card, obviously, for obvious reasons, the average ticket size is much higher than the other forms. But having said that, we do actually see, first of all, positive rub-offs in line with the kind of renewed interest of the customers for EMI loans. We have actually increased the share of EMI loans from 29 to 30%. So I think with a very low penetration, all of us are aware the credit card penetration is only around 4 to 5% kind. And with still cash being the dominant kind of part in the economy, I think a number of players, entry of new players and the new forms is only expanding the pie. And there is enough opportunity for everyone as long as we adopt a right strategy.
Saying that the pie is expanding, your quarterly spends that you saw has gone down a tad bit compared to last quarter. It's a little over 54,000 crores. On an average, you think this is sustainable through FY23 or could it get better?
In fact, the way to look at it is actually during Q4, January was impacted on account of wave 3. Of course, for a very limited period as compared to wave 2 and wave 1. But there was a strong bounce back. In fact, some of the categories, like particularly the share of online continues to be quite robust. This is a structural shift we are seeing. Above 54% kind of spends are there. Such a new category of spends have emerged during the last 2 years, particularly health and wellness, or otherwise education, utilities, rental, etc. These are the new categories that have emerged. And keeping in mind that the travel has not come back fully, even travel continues to be below pre-COVID level, while all other segments we crossed the pre-COVID level long back. I think the momentum is likely to continue. As long as there is no major external disturbance, we are hopeful that it will continue. And lastly, I will only say like a Q4 has always been a tad lower as compared to Q3, which is dominated by a festive period and elevated spends during Q3. Looking at that in that context, the seasonality is a major factor, and it's only a marginally 2% decline quarter on quarter in Q4.
Right, Mr. Two last points from my side, Mr. Amara. One is how are you thinking about the impact of MDR regulations? I mean, I guess we'll have to wait for the draft paper. And second, if you can talk about the level of competition from other banks and buy now, pay later kind of products as well. I mean, as at the end of the last quarter and right now, has the competitive intensity increased or gone down?
Firstly, around the MDR, as you rightly said, Prashant, the discussion paper is yet to be out. But always, whenever there was a kind of discussion around MDR, in the past, we were able to engage with the regulator in terms of saying like how we should be given or why we should be given a separate dispensation. Because of the unique things what we do in the credit card, we fund the funding cost is borne by us. Risk is borne by us, and then there is a rich value proposition behind the card, which have to be funded through an appropriate MDR. This argument was brought in by the regulator at that time, and we are sanguine that actually this time also we'll have the similar kind of opportunity. But having said that, if at all, if any small tweaks are there in the MDR, we will be able to use the levers like a free credit period or otherwise a reward cost kind of thing without actually seriously impacting the attractiveness of the product. With regard to your second question on the competition, etc., as I said earlier, we have been seeing a intensified competition. But we have also taken a lot of steps, particularly the declining credit cost is giving a lot of confidence to us in terms of exhibiting a better risk appetite. We have diversified the channels, we have acquisition channels, we have access to the SBI's customer database in terms of certain programs. So we are quite hopeful of facing the competition. And as I said, there is enough room for every player to grow.
Okay, so there is a lot of competition, but you're doing your best to battle that, combat that. You know, Morgan Stanley put out a note where they said that this could be the start of an earnings upgrade cycle for the industry as well as for SBI Card because of falling credit costs as well as revenue acceleration. Do you think this is the start of a multi-year earnings upcycle for the industry?
I mean, we are hopeful. As I said, like a credit costs have been contained very well, and particularly the ECL, which is a kind of forecast for the future losses. I think it has come back within the band of what we used to see in the pre-COVID level. Gross credit cost, of course, there is a lag effect that will again align to the pre-COVID level very soon. We are hopeful. I mean, the robustness, as long as we have a right strategy in terms of a customer acquisition, and matching the cost with the kind of revenue that accrues from the particular customer segment, I think the operating earnings will improve.
All right, Ms. Amara, thank you very much for your time. Great speaking with you, and as always, great getting that perspective from you. The market, by